Retail sales this morning came in kind of mixed, but still positive. And we saw industrial production manufacturing on the manufacturing side up fairly strongly. What does that tell you about where the economy is and whether you have done enough to slow things down and bring inflation lower?
Well, my take is that demand is cooling, but it's not yet cold, and I think that's what you saw today. We had this big spike on all of the demand metrics in January, but February, March, April, I think they're coming in much more flattish net of inflation, for example, in retail sales than they are up. And I think that's just a sign that the combination of all these things, rate hikes, eroding consumer savings, waning fiscal stimulus, are all affecting demand in the way that you would think.
Well, we've come down from 9% inflation to around 5%. The low-hanging fruit has been picked, as they say. Do you think you still need more restraint in order to get down, or at least get us moving back down towards your 2% target?
Well, there's a plausible story there that combines the things I was just talking about and add, credit tightening to say they're going to bring demand down and in time bring inflation down. I think that's a plausible story. I'll just say for me, I'm still looking to be convinced. I still see core inflation or trim mean inflation in the month-to-month 0.4% range, which implies we're sort of operating at an annual rate of around 5. And I'm still looking to be convinced that demand will come down, and then, of course, that will bring inflation down at a pace that won't erode expectations.
Well, what then becomes the tactic you would use? Do you think you need to probably go into the June meeting leaning towards a rate increase, or do you want to pause, see what happens, and start again, even though some people have said you don't want that stop-start?
Well, I liked the optionality that was implied in the memorandum that we did, the statement we did after the last meeting. Obviously, in this period, even this month, we're going to have a full month's worth of data coming. You've got questions about the debt ceiling and what impact that might have. You've got questions about credit tightening and how significant that might be. So I think it gives you time and optionality to say either there's still more we need to do, so let's do more, or it's still okay to wait, and we'll wait a bit. I think you have optionality either way.
So we put you down as undecided for the June 14th vote?
Put me down as tracking the information, tracking the debt ceiling, tracking credit tightening, and we'll make a call when we get closer to the meeting.
You've got some big banks in your district. When the Fed raises rates, banks always tighten credit standards, loan demand goes down. So the question is, are you seeing anything, or are they telling you they're seeing anything because of the bank issues we had in March that is worse than what normally would be expected?
Well, I've actually talked to all the banks in my district as best as I can. Deposit flows are stable. They've invested, of course, in making sure their liquidity is locked tight. I'm encouraged by the resilience I'm seeing. But I do then ask them about credit, how they're thinking about credit. And of course, if you're in a situation where deposits are repricing, that does mean they're going to look at the marginal credit a little bit tighter. And that could be the marginal consumer credit, certainly commercial real estate. Folks are telling me that credit's hard to get in that sector, small businesses. And then the only other thing you hear this particularly with the smaller banks, is they do worry about margin in the context of deposits being a place of so much attention and obviously repricing.
What about commercial real estate? There's a feeling that could be the weak point for lenders this cycle. Are they expressing undue concern, or do they see this as kind of a normal cycle?
Well, commercial real estate's a big sector, and so if you're in industrial or you're in retail or you're in multifamily, I think folks there feel the normal everyday pressures, but nothing out of the ordinary. But if you go to commercial office, particularly downtown commercial office, particularly B and C downtown commercial office, particularly in cities like Washington where people are not back to work, that's where you hear the most concern. And I think folks are concerned until occupancy rates get back to where they were beforehand. I think they do worry about valuations.
Well, are you concerned as a policymaker about the damage that CRE issues could do to the economy, or is it just kind of something at this point that is in the mix?
Oh, I'm watching that closely, and I think that is a vulnerability. Now, it's not an unknown vulnerability. We've seen commercial real estate challenges before. We know how that plays out. We know what to track, what to monitor, and we know that that happens over time, not in a big fell swoop. But it's certainly a vulnerability that I'm focusing on.
Unemployment is not behaving as the Fed forecast it would. How are you thinking about that now? When you go into June and you do a new projection, are you still going to see unemployment at 4.5%, or do you think it comes down?
Well, the job market, 3.4% unemployment. Maybe we're no longer red hot, but we're certainly hot. And some of the secondary indicators may be softening, quits, claims, but the unemployment rate is still a critical variable here, and it's still quite hot. So that's how I see it, and therefore it has not softened as much as I would have imagined 3 months ago. So I'd imagine my forecast will come down a little bit. One thing I'm watching closely is the professional segment, because if you look at the layoff notices over the last 6 months, they by and large haven't been in the sectors that they used to be. Sectors like construction or manufacturing or even frontline service workers, those places are still tight. They've been much more support and overhead technology kind of layoffs. And the unemployment rate in that group is quite low. The propensity to file for unemployment is quite low. So one thing I'm playing around with is the idea that maybe unemployment won't spike as much as normal, because the folks who are being displaced are folks with less propensity to unemployment and a faster ability to repot.
Well, what are CEOs telling you in your district about their labor plans? Are they hoarding people because they're hard to find, or do they think maybe we aren't going to go into recession, so there's not a need to let people go?
Most of the folks I talk to do anticipate some sort of a downturn coming over the next few quarters. They've got the recession playbook out and they're working it. But when it comes to downsizing, I think they're quite cautious. And it's exactly the reason you talked about. They fought tooth and nail for 18 months to try to find workers and hold workers and retain workers. They're just reluctant to let them go. That's particularly true, I think, in frontline service workers, manufacturing, construction, places where they're just concerned there's an overall shortage and they just don't want to have to go back to where they were 18 months ago.
Are they still paying more to attract workers, or is that trend starting to slow?
Frontline pay is still elevated, still high, but absolutely the year-over-year rate of increase is coming down. And when I said that's moved from red hot to hot, 18 months ago, there was desperation. You really couldn't get the job done. Now, folks are getting the job done. It's just a question of vacancies or concerns. Attrition rates are down. And so I think the pressure on compensation is down.
What about on the price side? Are people finding a limit to their ability to raise prices, or do we still see that trend continue?
Well, most people think if there is a recession, 2 or 3 quarters down, they're not going to have the pricing power that they had last year. But they're not going to give it up without being forced to give it up. And if you look at a lot of the earnings reports over the first quarter, particularly in consumer goods, you saw a lot of companies with prices up 10 to 12%, maybe volume down 0 to 2%, and therefore revenue up 10-ish. And folks who have that business model aren't going to stop increasing price until customers or competitors prove to them they have to. And so that's, I think, what you're going to see is there are places where price increases have stopped or stalled, but there are a lot of places where they're continuing. And that's what's behind the elevated inflation we're seeing today.
So when you put it all together, how would you describe the economy? Is the soft landing still a good possibility? You said most people that you talked to are forecasting a downturn, but what do you see?
Well, there's a plausible story that we get inflation down due to a lot of the actions that have been taken in the past, both ours and by others. But like I said, I'm still looking to be convinced on that story, and it may take more.
Now, when you say you're looking to be convinced, do you think it's a good idea to stop for a while and then start again, because that sends mixed signals, according to Chairman Powell? Or is it better to be cautious because you have done so much and you don't know the full effect of tightening on the economy? Well,
I think the message sent in the last statement was one of optionality. It wasn't one of a pause or a peak. It also wasn't one of a predetermined course that we were going to increase if we have to. Uncertainty's high, environmental uncertainty, and also uncertainty about the impact of what's happened to date, lagged effects of rate increases and the like. And so I think in the context of that uncertainty, a path that is cautious but not stuck would be a good way to put it. So I do want to learn more about what's happening with all these lagged effects, but I also want to reduce inflation. And if more increases are what's necessary to do that, I'm comfortable doing that.
The idea of hold for a very long period of time, I assume you're on board with what everybody has said about that. You get to a certain level and you're not going to be cutting rates anytime soon. But if inflation comes down quickly, would you cut rates? Obviously, if the debt ceiling goes over the cliff, you might be forced to. But is your preference to just get up to a certain level and stay there?
The Richmond Fed's done a lot of work on the lessons from the 70s. Number one lesson of the 70s is don't quit too soon. And don't back off of fighting inflation because you're worried about what the other consequences might be. And so I definitely buy into that school. I think you want inflation put to bed finally and firmly. And if you don't do that, it'll come back higher, and then you'll end up doing even more damage. So, yes, I'm in the world of let's make sure we have convincing, compelling evidence inflation is behind us.
Now, the Richmond Fed has, like everybody else, bank examiners there, and you have some big banks in your district. Does something about the banking supervision practice need to change, you think? We have Michael Barr up on the Hill today. Is there something from the regional president's viewpoint that needs to be adjusted?
Well, I don't want to front run whatever he's saying today, but I read his report with great interest, and it resonated to me. And so I certainly think the parts on supervision that are practices in our world and other banks, I think those are worthy places for us to push.